Before the dollar became the world's reserve currency, there was a soft, shiny metal that backed the world's currencies. Without a standard for limiting the government from printing out infinite amounts of paper money, the gold standard was used to limit inflation from growing out of control by backing up a physical quantity of gold for a paper money system, and by creating a balance between currencies. Gold prices have skyrocketed recently as money is artificially injected into the economy and with the dollar's value being threatened. But there is a reason why gold is avoided by many investors. It's because gold is rarely used to produce goods, with the majority of gold being used to make jewelry. As Warren Buffett has famously said before, if you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end.
But we can go beyond that. But certainly, when we took over Berkshire, Berkshire was selling at $15 a share, and gold was selling at $20 an ounce. And gold is now $1,600, and Berkshire's $120,000. But you can take a broader example than that. If you buy an ounce of gold today and you hold it 100 years, you can go to it every day, and you can coo to it, and you can caress it, and you can fondle it, and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it, all kinds of things. For 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end of the 100 years. You could buy the Dow Jones Industrial Average for 66 at the start of 1900. Gold was then $20. At the end, it was 11,400. But you'd all gotten dividends for 100 years. So a productive asset of any kind, a decent productive asset, is going to kill a non-productive asset over time now.
But recently, many followers of Buffett were shocked when it was reported that he was buying gold. It's not exactly true, but I will discuss this in detail at the end of the video, so stick around. For now, let's listen to a few other well-known investors, starting with Bob Prince, who talks about investing in gold as a replacement for treasuries due to the low interest rate environment.
Because what I'm trying to understand is whether gold in a portfolio right now can not only do well in a reflationary trade, but also in a disinflationary, deflationary moment. And Bob, typically that's not something we would talk about with concerns to gold. What are your thoughts on that?
Definitely, yeah. And historically, that's been true. In deflationary periods, the reason is because in deflationary periods, deflation is so damaging to an economy that the government, the monetary system, the central bank, the government will do everything in their power to devalue the currency and print money in a period of deflation to restore a zero or positive inflation rate. And so gold is really a currency. It's really a contra currency. The value of gold is really just reflecting the value of the money that you used to buy it. Utility value of gold hasn't gone up at all. But what's happened is that the supply of money to buy gold has increased, and so gold has gone up in money terms, which just means money has gone down in value in gold terms. And so, definitely in a crisis situation, you do tend to see that, and for those reasons, and also in an inflation situation, you tend to see that. But I think that the way to think about gold is really as a currency. You could hold physical gold, of course, and in today's world, you don't have any yield, penalty for doing that, really. But I think the better way to think about it is that, let's say, if I take a storehold of wealth asset and denominate it in gold as a currency, or denominate a storehold of gold asset, a storehold of wealth asset in some combination of storehold currencies, including gold. That's the composition of a portfolio that can sort of leapfrog over the virus situation and the economic destruction that will be occurring, be a storehold of wealth, really.
So in times of crisis and risk of high inflation, with money being printed out to support the economy, investors tend to flock towards gold as a storehold of wealth to park their money in. El Arian, who previously served as the CEO of Pacific Investment Management Company, with over $1 trillion in assets under management, also seems to have similar thoughts on gold.
Thinking about treasury replacement in the portfolio, Mohammed, what are you thinking about replacing it with?
So I think increasingly it's about a portfolio. You want that part of your asset allocation to be a risk mitigator. And what I've seen smart people do is combine treasuries, high quality investment grade, and solid real assets. Okay, and it's that combination that's replacing just an allocation to treasuries.
Where does gold come into that, Mohammed?
In the third category. And what's interesting about gold is it's starting to become everything to everybody, a little bit like what happened to big tech. People like it because it's defensive. People like it because it's a reflationary trade. People like it because it's inflation protection. So what you're starting seeing is the narrative about gold is starting to be like the narrative about big tech. It gives you everything. So that explains why you're seeing some basic, important structural allocations in favor of gold going on.
El Arian thinks that gold is so appealing to many investors like the big tech companies that have been soaring because they are seen as a defensive investment in a risky environment. So it's clear to us now that gold can be a substitute of treasuries in times of zero interest rate environments. So should we invest? Let's hear the opinion of one of the biggest bears against gold, Ken Fisher.
People ask me, should you hold gold in your portfolio? Should I hold gold in my portfolio? I don't know. Kind of depends who you are. Fact of the matter is, I did so badly trying to forecast gold when I was young that I made a solemn vow to never make a forecast about gold ever for the sake of good luck. And I never have since. I don't make forecasts about gold. Since I don't make forecasts about gold, I don't use it in portfolios because I know to accomplish what I need to accomplish, I don't need gold. But my point to you is if you can forecast gold well enough to justify putting it into your portfolio, then you don't need any advice from me at all about anything because gold is very volatile. About 80% of time, gold loses money. And then in the other 20% of time, it does very, very well. It's a commodity. It's volatile. It has these long periods of slowly losing money followed by these short bursts of big up move. And most people sell out of the gold that they've owned when it's just about to go up. They in and out at all the wrong times. My advice to you is if you know how to price things that well and trade that well, don't listen to me about anything. If you actually don't, there's a lot better ways than gold to build a portfolio to get to where you need to go to.
Gold is a very volatile investment with prices potentially falling very quickly and rising very quickly. If you look at the price history of gold, we see the prices go up very dramatically and also falls very quickly. And so even professional investors like Ken Fisher can lose money investing in gold. So I would be very cautious with investing in gold right now, especially with the prices so inflated compared to the historical average. So given all this, why did Warren Buffett buy gold? There's a lot of speculation out there on why he decided to invest in gold now, but I think one important thing to note is how much he invested in gold. It's reported that he bought 21 million shares of gold miner Barrick Gold, spending about $563 million. For you and for most other people in the world, this is an insane amount of money, but you have to understand that Berkshire is one of the largest companies in the world, with billions of dollars of cash on hand. So right now, Berkshire has about $146 billion in cash and short-term investments. So to make a similar comparison, Berkshire's investment in gold is kind of like someone with a net worth of $140,000 investing $0.50 into gold. So I think people are overstating the implications of this purchase. And I think all that Berkshire did was put a very tiny hedge just in case inflation strikes the economy. And since this investment was so small, the person who made the decision to buy gold probably came from one of Berkshire's investment officers like Todd Combs. So overall, I think people are overreacting to the news. And if you decided to put in a substantial amount of money into buying gold just because Warren Buffett did so, you might want to reconsider your decision. That's gonna do it for this video. Don't forget to hit the subscribe button with the notification bell icon turned on, and I will see you guys in the next one.